Welcome to another episode of the Schlegel Design Remodel podcast. As we know, remodeling can be very expensive, especially in today's world. And sometimes figuring out how to pay for that can be very tricky. So today I'm excited to be welcoming a senior mortgage consultant from Capital Federal, John Otten, to the podcast. John, welcome.
Thank you, Amy. Happy to be here.
So, how long have you been in the financial world?
So I've worked at Cap Fed now for 34 years and been in my current position for about 17, 18 years.
Wow, that I feel like you have a little bit of experience then talking about these things.
Yes, I've seen a few in different markets in the real estate arena, and some good, some bad, and we're definitely in an interesting market right now.
Yeah. Yeah, I'm sure. I know. I'm excited to get your take on some of that. So, we'll jump in. There's lots of different types of loan options and everyone's in their markets are different too, but CapFed has kind of their own offering. Are you able to talk about several of those options and when they might make sense for homeowners?
Absolutely. Yeah, a lot of it really comes down to probably three different questions. What type of current interest rate the borrower might have on their existing mortgage or loan? And then secondly, the size of the project they're looking to do, because that's going to differ as to what financing option may work out best. And then thirdly is the amount of equity that they may currently have in their property. In other words, how much is the house currently worth based on what they owe on it? Because that will determine what type of product might be the best fit for their scenario as well.
That makes sense. So let's say that someone from Kansas City reaches out to you and they have a very large scale remodeling project. Where do you start them? Where do you start with those questions?
Okay, good question. Yeah, a lot of times, unless they've got an awful lot of equity in their current home, that's going to drive us to refinancing their existing mortgage and doing what we call a refinance plus mortgage, or it could be a purchase plus. Purchase would be if they didn't own the property already, but typically when they're calling me, they've been sent by a contractor, in this case, like, and they're looking to do a large remodel project. And so we're going to do what we call a refinance plus. What that does is we get the bid from the contractor up front. And when we do the appraisal, we're actually taking into consideration that work that they're going to be setting up. In other words, we're giving them credit for maybe they're doing a whole house remodel. Maybe they're doing a basement finish with a kitchen remodel. Maybe they're doing an expansion, a second floor addition, whatever it is. We're going to appraise it as if that work was already done. So what that does is give them the ability to take advantage of future equity that they're going to have in that property before the improvements are ever completed. And then based on that scenario, we will lend up to 80% of that appraisal without PMI insurance, or 90% of that appraisal with PMI insurance, PMI being private mortgage insurance, just a monthly fee the borrower pays due to the elevated loan to value considerations. But either one of those options would work typically the best for a large scale project.
John, I have already shared this, so I'm not trying to hide it, but I have done that exact thing for our home. And it was amazing because it's something that we otherwise might not have been able to do, but it still is great because you still are appraising your home. So you're not overvaluing your home for the market, which was a nice thing to know when you're spending a larger amount of money on a project.
Correct. And it's good to know that up front too. You actually know what that house is going to appraise for before the project's ever kicked off. Because we've had cases where, certain neighborhoods, areas that may or may not add as much value as they were hoping. We've had to kind of switch gears and maybe do a smaller project, or it comes back higher than they thought. And they may want to do a little extra work.
Yeah.
Hey, let's go all in with doing this while we're at it because we got a really good appraisal.
Yeah. That it does. It totally makes sense because sometimes, you know, you don't know how much when you put money into your house that it's going to be worth. And sometimes you kind of outsize your market. But with this, it works great. Is that loan a common option among lenders or is that something unique to CapFed?
Yeah, that is very unique to Cap Fed. There's probably only a half a dozen lenders or so in Kansas City that have a project like that, where they can actually give value for future improvements. Pretty much everybody will loan off the existing equity you have in the property, but very few lenders have a project like that we just went over, talked about, called again our refinance or purchase plus loan.
Sure. Okay. And you did mention what their current interest rate is. So let's say that someone had bought when the market was offering better interest rates and they're interested in doing this, but today's interest rates are a little bit higher. What would you recommend in that situation?
Well, it's going to come down to the size of the project and how much equity, again, they have. But let's say they have enough equity in their existing home. And I've done a few of these recently. Somebody owned their house almost free and clear, but they wanted to do, some financing against a project. If it's a smaller project, a lot of times we'll do a second mortgage. Those are going to be a little higher interest rates. So that doesn't interrupt the existing first mortgage. That just stays in place. So they don't lose the rate they have, and all they're looking at doing is their second mortgage. Now, in that case, I'm doing the appraisal, however, based on as is value. I'm not giving any consideration to future improvements. So they're not getting an inflated appraisal. They're getting the appraisal based on the project that sits now. And in certain situations, we may be able to use a county appraisal to make something like that work, again, depending on how much equity they have and the size of the project. Those rates, you can either do a second mortgage. You have two options on those. You either got what we call a fixed rate second, where it's similar to a first mortgage. It has a fixed rate, a fixed payment. The payment never changes. It's done over, 10 years, 15 years, 20 years. Or you can do what we call a HELOC, a home equity line of credit. Those are typically set up almost like a large credit line or smaller credit line, depending on the size of the project. And they basically only make payments on whatever portion of that credit line they're using each month. So obviously it starts out when they do the project up front, they haven't used really any of the credit line. So they're really not making a payment maybe that first month. And then they do part of the project, they start making a payment, and they do more of the project, make a bigger payment the next month. And that line of credit just stays open for a period of time. In ours, it's a 7-year period where they can draw against it as much or as little as they want to in that 7-year period. The rate on those, the fixed rate second is obviously a fixed rate, like their first mortgage would be. The line of credit typically, and no different here at Cap Fed, is going to be tied to prime. So it's going to be prime plus something. In our example, our current rates are prime plus 0.5%. That would be if they keep the combined loan to value at 80%. If they go above 80%, then the rate goes to prime plus 2.5%. They don't pay any PMI insurance on that loan like they would a first mortgage. We're basically self-insuring those second mortgages. That's why we're charging a higher interest rate when the loan to value gets above 80%, because we're effectively self-insuring those loans.
So that evaluation comes when they take out that line of credit. So let's say you have that open for 7 years, that appraisal comes right when you take that loan out. Is that how that works?
It, it does. Yeah. And then they can reapply later on, if they want to increase the amount, maybe their home value has gone up or the 7 years is up and they decide they want to have a line of credit available again, we can just put a new one in place based on the then current value. The reason we do the 7 years is simply because we want a chance to take a look at their financial situation about every 7 years. Sometimes we'll set up a large line of credit. Maybe somebody's financial situation will change. They were working, now they're retired on more of a fixed income. We may or may not want to leave that line of credit out there for 100 or 200,000 under that scenario. So we like to look at those situations every 7 years just to make sure that it makes sense for both the borrower and the bank to keep that line of credit active.
Yeah, it makes sense. And from my perspective, yeah, if the interest rates are better, that might be a good time to reevaluate that program. So what's the difference between the home equity line of credit and just a home equity loan? Is there a difference in those?
Yeah, the home equity line of credit is a line of credit. So they're setting up for a dollar amount and they can use any portion of that they want. The home equity loan would be just a variation, but usually it's more of a fixed rate, fixed term type scenario. So our home equity loan, we would actually do as a fixed rate, at certain, depending on loan to value and depending on how long they want to pay it back over would depend on the rate. But again, those are going to be higher rates, but they're fixed versus the home equity line of credit is going to be a variable rate. Anytime prime changes, that line of credit rate is going to go up or down. Now,
Oh,
on the line of credit, the actual payment is determined by the balance. Here at Cap Fed, anyway, we calculate the payments based on 1.5% of whatever the outstanding balance is that month. and that's what the customer pays as their minimum payment. On the fixed rate, the payment never changes because it's a fixed rate, fixed term, but they can't use it again for
Sure.
future improvements, or they can't pay it down and use it to pay off a car loan or a credit card or something like that. Whereas a line of credit, they could use it for anything conceivably they wanted to. Now,
Sure.
they're only able to deduct the interest, however, on that home equity line of credit or fixed rate second if they use it for home improvements, to the best of my knowledge. I think that changed to back in 2018 with some of the tax changes, but that'd be something they'd want to consult their tax advisor on.
Okay. So literally a line of credit. It's like a credit card, but against your home value.
Correct. Yep.
Okay. Are the processes different for the different types of loans you've talked about when the homeowner comes to you?
Yeah, anytime it's a new first mortgage, which would be like the refinance plus, or it could be just simply a cash out refinance. Maybe somebody likes the idea of having everything on the first mortgage, having it fixed. And again, if it's a larger size project, they may not want a big second mortgage out there that's on a variable rate. So anytime we're doing a new first mortgage, it's going to probably take, somewhere 35 to 45 days to do everything because there's more paperwork involved in those. If you're looking at any type of second mortgage, home equity line, fixed rate second, like that, those are typically probably 30 days or less to get financing in place, and could even be a little quicker in certain circumstances, especially if we don't have to do a new appraisal. If they have enough equity in their current home based on the county appraisal, for the second mortgages, we may be able to use the county appraisal. Where on the first mortgage, we're going to always require a new appraisal.
That makes sense to me. So if, for example, you were doing just a small little bathroom in your home, potentially a home equity line of credit might be a really good option instead of going through the whole process of appraising your home and a whole new mortgage, right?
Yeah, that's correct, especially if they have a pretty attractive rate on their current first mortgage. The only time it makes sense to do a new first mortgage would be, and we had this happen last year and the year before quite a few times where, people had a higher interest rate than our current rate. So the refinancing made a lot more sense. But now with rates going up substantially this year, we're starting to do more home equity lines of credit, more fixed rate seconds than we are doing the cash out refinances and the refinance pluses, unless, again, it's a situation, it's a big project, or they just don't have enough equity without getting that inflated value, figuring in the improvements into the new value of the home. The other main difference would be closing costs. On a first mortgage, you're going to have a few more closing costs, probably somewhere in the ballpark of 2,500 to 3,000, maybe 3,500. Where on a second mortgage, those are going to be anywhere from zero on a home equity line of credit if we use the county appraisal, all the way up to maybe $1,000 or $1,100. So they're going to be a little less on the closing cost side on a second mortgage or home equity line of credit as well.
Are second mortgages looked at as, I guess as a homeowner, I'm always a little like, to have two mortgages. Is that something that the financial world looks as a negative thing, or is that pretty standard thing for homeowners?
No, it's pretty standard. We see a lot of people that do have second mortgages these days. In fact, a lot of financial planners will tell their customer, go out and get a home equity line of credit set up, even if you don't plan on using it, because the bank doesn't charge the customer anything unless they use it. So we do see quite a few homes that have second mortgages on them. It's not anything negative or to be frowned upon. It's just nice to have, and the availability to know that, hey, if I ever need money, I can stroke a check or go to the bank and get a check for a project I want to do, pay off a car, finance my kids' college education, consolidate credit cards. It's just nice to have that availability out there.
It is nice, especially, as a homeowner, you occasionally all of a sudden out of nowhere have to re-roof your house or put a whole new HVAC system in. And those payments aren't cheap. And even sometimes you might have the cash, but it can take time to move money. So having that fallback option would be really nice for people.
Absolutely.
All right. How about a personal loan? What exactly is a personal loan and how does that differ from some of the loans we've talked about? And is that a good option for remodeling?
Typically not, at least on our personal loans, because they're limited typically to $5,000 or less. So it'd be a very small loan that you'd be looking at. And usually the rates on those are quite a bit higher. I think the last I looked, it's probably going to be somewhere around, I'm going to say maybe 14%, 12 to 14% on the rate on those. So it'd be similar to doing a credit card at that
Yeah.
point. But again, that would be a very small project for a personal loan. Typically, we're looking more at the options we've gone over to previously for these remodel projects.
Yeah. Yeah, that doesn't seem like a good option at all at that interest rate. So, is there anything that a client should know or consider when determining what's the best loan for them? I know you've talked about a lot of those things. Is there anything else that you guide them on outside of those types of things, or anything that you look at in addition to those?
No, that would we pretty well covered what I would go over with the client. Again, a lot of it comes down to those first three questions I asked: current interest rate, the amount or size of the project, the amount of equity they have in the home. Once you have those three things nailed down, you can pretty much direct them as to what might be the best, and then it might be a matter of what is the best option.
How does your credit rating impact these options? Today, luckily, we can go look at our credit rating on so many different sites and know what it is. But what advice do you have for what type of credit rating you need for some of these loans?
Yeah, with Cap Fed's going to be a little different than most lenders from the standpoint that we hold on to all the loans we originate, which is very unique in this Kansas City market. So whether it's a first mortgage, second mortgage, home equity line, whatever it is, we plan on holding on to those. So we don't differentiate our interest rate structure based on somebody's credit score. Having said that, a lot of lenders, especially on the first mortgage side, they are going to give you different rates depending on your credit score. So then you definitely, if you have a lower credit score, probably I think the market mostly wants a 740 or better credit score to give you the premium pricing. You drop below 740, then definitely starting to shop that loan between different lenders. Another like Cap Fed that may not charge a higher interest rate for a lower credit score may have a lot more favorable terms for the borrower. But obviously, as you mentioned, you can pretty much determine or get a hold of your credit score pretty quickly. I will say that when a bank runs a credit score, it's going to probably come back a little differently than what you're getting. Ours are really up to date. A lot of those ones that are free, they're not quite as up to date. Sometimes if you've had a recent change, you've opened up a new account, you've had a recent late payment, that may not really have hit your credit score yet, whereas it does on the scores we're pulling. So ours are very up to date and sometimes a little different than what a customer's getting. But most lenders are going to differentiate on their interest rate based on your credit score, at least in the first mortgage world. Now, on a home equity line of credit or second mortgage, maybe not quite as much. But average score in America is probably in the ballpark of maybe 680 or so, last statistics I saw. So 680 or above is, not a bad credit score. You're starting about 700, 7 to 750, I would say is excellent. 750 to 800, is very, very strong. And then 800 above is just superior. I mean, we don't see tons of credit scores above 800. Probably, if I had to guess, I'd say 8 to 10% of all borrowers in America have a credit score above 800.
That's interesting. You said so many things in that information. So the first question, I guess not a question, it's a comment. I guess I've never thought about that. CapFed doesn't resell your loans. And a lot of companies do. The minute you get it, all of a sudden it changes hands to another bank or even your car loan. So that was an interesting point. And I don't know that I have anything other questions, but yeah, that was an interesting point. Is that do a lot of banks, do most banks resell that loan?
Yeah, I would say probably 80% of the lenders in Kansas City do sell at least their first mortgages, simply because they're not set up. If you make a loan to somebody, a 30-year fixed, you've got to be able to expect you're only going to get 360 of that back each month for the next 30 years, potentially. So you have to have a pretty good asset base to be able to hold on to loans. Most lenders are just kind of turning money. They make the loan and then they sell it to an investor and then they get that money back and loan it out to somebody else. So they're making money off the sell of loans and fee income. Whereas we're trying to develop relationships with clients and customers and are very interested in having a long-term relationship with that customer. What better way to have a long-term relationship than to develop that by servicing their loan for them month after month, year after year?
Yeah, for sure. And that's nice to your point, have the relationship, know who you're talking to at a bank, and also to know that your bank's local and not sold off to some other big company. But that's funny. I never even thought about that, but that's true. And then the other thing that you had mentioned was the difference between what you can pull in a credit score and what we see. And that's, again, it's just another interesting point because I feel like every time I see those credit scores on the app I use, it's not at all current. Like it doesn't have the current payment. It doesn't have the, my last mortgage payment or my credit card. So that is interesting. If you pay for that service, can you get the most current one, or is that something really only the financial industry has access to?
No, I'm guessing you probably can. If you pay for the service, you may be able to get more current information, but most of those are just provided to you at no cost. And so they're going to give you a ballpark. I mean, rarely do I see somebody says, I got an 800 credit score and I pull it and it's 620. That just doesn't happen. But I do have cases where people say, well, I got an 800 credit score. I'm in that superior category and I pull it, it's 758. They're saying, what happened? How come it was 800? Now it's 758.
Yeah.
Credit scores it's fluctuating every month, literally based on several factors. If you've made a recent late payment, that's going to drop it substantially. If you have a lot of balances on credit cards, so they look at what they call a utilization ratio, a debt utilization ratio. So if somebody has a $10,000 credit limit and they've got a $7,000 balance on that they've used 70% of that credit limit. To obtain an ideal credit score, you typically don't want to use more than 1/3 of your credit limit. So on a $10,000 card, you wouldn't want to use more than about $3,300 at any time as a balance on there, whether you carry the balance or not. Because as soon as you use that card and it gets reported to the credit bureau, because they all report once a month, whatever the balance was that day that creditor reports, that gets what gets reported to the credit bureau. So if it's more than 33%, that's going to start to impact your score a little bit. If you have two or three or four cards like that, that's going to start to impact it even more. So somebody says, well, how do I raise my credit score? Well, it depends on what's affecting your score. Is it due to your late payments that you've had? A 30-day late is not as serious as a 60-day late. Is it due to a collection account? If a collection account hits, that'll drop your score substantially. Is it due to just debt utilization where you have a lot of balances out there? Is it due to the number of cards that you have balances on? They look at that as well. Because typically when people get to their maximum utilization of their credit limit, it doesn't mean they stop spending money. They just go out and open up another credit card, and now all of a sudden they just take on additional debt, which makes it a little more risky profile.
That was my question. Is it percentage of each credit card or is it percentage of total credit cards? Because that someone's solution could just be, I'll just go open some more lines of credit, which doesn't seem maybe like the best solution.
Yeah, they do base it based on each individual credit card that you have, your debt utilization ratio. Again, about 33% is where you want to keep it at or lower to obtain a good credit score and help improve it.
Yep. Yep. That makes sense. And also really interesting that it's like a whole world out there dealing with credit, all the little nuances. Okay. And then do you have any advice, suggestions for people that are just starting to either look at, for us, remodeling, or but maybe it's purchasing a new home? Where do they start for financing? Where do they research? Where do they look at interest rates? What kind of banks should they be looking for? Do you have some wisdom you could impart upon them?
Sure. Yeah, they typically, I mean, rate's going to be important, and that's what everybody is most conscientious about. They also want to look at the servicing we talked about. Is this lender going to hold on to my loan or are they going to sell it? They want to compare closing costs because that does come into the equation. And then just basically the type of project they want to do. For instance, we talked about a large project and that refinance plus. There's just not many lenders out there doing anything like that. So sometimes you're kind of pigeonholed into what your options might be based on what projects or products might be available in the community. But it definitely, behooves you to shop around a little bit and do your homework as far as, comparing the rates, the closing costs, the servicing, some of those things that might be important to you. How long is the lender going to take to get you closed? How quickly do you need the money? All those things start to come into play.
Yeah. I will say I feel like I'm plugging cat fed here, but we were really happy working with you guys. And yeah, not a lot of banks did what we were wanting to do, but you guys knew we live in Leawood, our market really well, and we felt really comfortable moving forward with that. So again, it's given us the dream home we always wanted, and it was an awesome option. So a great plug for Cat Fed on that.
Well, super. Thank you for that comment.
Yeah. I don't think I have any other questions. Is there anything else that you were wanting to cover or anything else you wanted to share?
I will say too on that refinance plus loan where we're setting it up, we actually do set up a construction account with that and then do payments or draws with the contractor. So the customer is not really too involved other than approving the draws. They're not really involved in cutting the checks and all that. That's done behind the scenes internally with CapFed. Whereas if they're doing a second mortgage or a cash out refinance or something like that, we're just giving them the money or the availability to get access to the money. And then the customer cuts the checks or pays the contractor or does whatever they want to do with the funds. Whereas the refinance plus, because we're giving value off of future improvements, we have to make sure those future improvements do get done. Otherwise, the house isn't worth what we appraised it at. So we do
Sure.
control the payouts a little more.
And I've thought about that actually. I've known a few other neighbors who've done similar things, and it's actually advantageous for them that you are cutting those checks and tracking their project too, because it holds remodelers accountable as well. Unfortunately, people in the remodeling industry don't always get things done on time, and that kind of keeps them on track too, because in order to get paid, you have to be at a certain place along the project. So I thought about that going into that project, that is nice for the clients to have that little built in.
Yeah, it creates a little checks and balances, so to speak.
Yeah, it does.
If you want to reach out if they have further questions, and we're more than happy to entertain those questions about anybody that has, after hearing the podcast, has additional questions, feel free to reach out to myself or any other loan officer at CapFed or any other lender they work with.
John, I really appreciate you carving time out of your busy day to share more about loan options and financial impacts to clients and anyone just looking to do projects or take out a mortgage. And if anyone has questions, I will have John's information alongside this on our website. But John Otten at CapVet.
Enjoy being with you today.